Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, picture this. You've built a killer real estate portfolio with your partners. Things are great, but now it's time to sell and you hit a wall. You want to reinvest, but your partners, they want to cash out. It's a classic standoff, and today, we're going to figure out how to solve it. So, you've done everything right. You're all set to roll your profits into a new deal, using that beautiful 1031 exchange to defer those hefty capital gains taxes. But your partners want out. They just want the cash. And suddenly, you're staring down the barrel of a massive tax bill you never planned for. This isn't just a what-if scenario. This is a real trap that investors fall into all the time.
So to really get our heads around this, let's walk through a super common example. We're going to look at a simple 3-member LLC that finds itself right at this crossroads.
Okay, so here's the setup. We've got an LLC with 3 members. For more than 10 years, these guys have been playing the game perfectly, using 1031 exchanges to trade up properties and keep their tax bill low. But the good times might be over. They want to sell their latest property and go their separate ways. And here's the rub. 2 of them want to do another 1031, but the third partner, he's done. He just wants his cash and is willing to pay the taxes. So, can they all get what they want? Is that even possible? Okay, before we get to the solution, let's do a quick refresher on the tool that's causing all this drama in the first place, the mighty 1031 exchange. So, what is a 1031 like-kind exchange, really? Well, it's a little piece of the tax code that's a huge deal for investors. It basically lets you sell an investment property and avoid paying capital gains taxes on your profit if you use all that money to buy another like-kind property. It's not about avoiding taxes forever, it's about deferring them, kicking that tax can down the road. And trust me, that deferral is a game changer. I mean, look at these numbers. Let's say you bought a place for $100,000 and now it's worth a cool $1 million. That's $900,000 in capital gains. Normally, Uncle Sam would take a big slice of that pie. But with a 1031, if you reinvest that full $1 million, the tax on that entire $900,000 just gets pushed off. It's deferred. Pretty powerful stuff, right? So who can actually use this thing? Well, the good news is a lot of people. Individuals, trusts, corporations, and here's the big one for our story, LLCs. But there's a critical rule here that you cannot forget. The entity that sells the property has to be the same entity that buys the new one. In our case, that means the LLC itself is the taxpayer doing the exchange, not the individual partners inside it. Remember that, it's the whole reason our partners are stuck. And that right there brings us to the eligibility trap. Because the LLC is the one doing the exchange, it creates this massive roadblock when the partners don't agree. The solutions that seem totally obvious? Yeah, the tax code says no way. You know, the first thing that probably comes to mind is, hey, why can't the partner who wants out just sell their piece of the LLC to the other 2, right? They get their money, the other 2 carry on with the 1031. Seems simple enough, but nope. The IRS has something to say about that. And here's exactly why that simple plan falls apart. The 1031 exchange is all about trading real property. We're talking land, buildings, actual real estate. It has nothing to do with partnership interests. As far as the IRS is concerned, selling your share in an LLC is like selling a share of stock. It's a financial asset, not a building. And that means it is absolutely 100% not eligible for a 1031. So if they even try to do this, if they try to mix a sale of membership interests into the deal, it poisons the well for everyone. The IRS will look at the whole thing and say, sorry, you sold shares, not property. And just like that, the 2 partners who wanted to defer their taxes are disqualified. Boom, they're hit with that huge tax bill they were trying to avoid. So if the easy answers are off the table, what's left? Are they just stuck? Well, no. This is where the pros pull out a much more advanced strategy. It's an elegant solution to this exact problem, and it's called the drop and swap. It sounds complicated, but it's really a 3-step dance. Step 1 is the drop. The LLC is dissolved and it hands over direct ownership of the property to the individual members. Step 2, they're now what's called tenants in common. And step 3 is the swap. Now that each person owns a piece of the actual real estate, they can do whatever they want. The 2 who want to continue can do their 1031 exchanges, and the third partner can sell their piece for cash. Everybody wins! Now, this whole magic trick hinges on that legal structure, tenancy in common, or TIC. It's a crucial difference. See, with an LLC, you own a piece of a company that owns the property. With a TIC, you own a direct, fractional slice of the property itself. To the IRS, that's everything, because it means you are now selling real property, which, as we know, is what makes a 1031 possible.
Okay, this drop and swap sounds like the perfect answer, right? But hold on. You have to be extremely careful here. This strategy comes with some very, very strict rules. This is the fine print you absolutely cannot skip.
The biggest boogeyman here is something called the stepped transaction doctrine. Look, the IRS isn't dumb. If it looks like you just dissolved the LLC on a Tuesday so you could sell the property on Wednesday, they're going to see right through it. They'll call it a single, pre-planned deal, argue you never really intended to hold the property as individuals, and guess what? They'll kill your 1031 exchange. So with this strategy, timing is absolutely critical.
So how long do you have to wait? What's the magic number? Well, tax pros all pretty much agree. Think 1 to 2 years.
What that means is there has to be a real, significant gap in time between the drop, when you dissolve the LLC and get your TIC shares, and the swap, when you actually sell the property. You have to prove that you held that property as an individual investor, a tenant in common. A year is the absolute minimum, but 2 years is even better. It's the safest way to show the IRS this was a legitimate investment plan, not just a tax gimmick. This is not something you decide to do last minute.
And finally, you gotta know that this trick doesn't work for every type of business. An LLC or a partnership, yep, you're good to go. They're pass-through entities, so they can usually distribute property to the owners without creating a tax nightmare. And a TIC is obviously already set up for this, but corporations, we're talking C Corps or S Corps, no way, they can't do it. Why? Because the moment a corporation distributes a valuable property to its shareholders, that distribution itself is a taxable event. It triggers the very tax you were trying to defer, making the whole thing pointless.
So what's the big takeaway here? It's that the legal structure you pick when you start an investment can have massive consequences when you want to get out. It really leaves every real estate investor with a critical question to ponder. Knowing what you know now about how tricky these exits can be, how are you going to structure your next group deal to make sure everyone has the freedom to choose their own path?